Hello and welcome to Core Finance. I'm Matt Brown. I'm joined by Mike Van Dolken, Head of Research at Ascendo Markets, and we're going to talk about something that maybe was off the radar a little bit over the summer, but certainly it's becoming more prominent and becoming a lot more interesting. Brent crude.
Yes.
Now, well, $64 a barrel. I believe that we're at almost 2-year highs. And obviously there's technical, we're going to look at the technicals, but there's a lot of fundamental reasons for why we've seen that push higher with everything going on in Saudi Arabia at the moment. So just talk us through an overview of where we are with Brent.
Well, as you said, for most of this year we've traded in a $45 to about $58 range. That's for Brent. US crude, it's slightly lower. And we had seen some very strong positive momentum from the summer, which was on the premise that existing production cuts would be not only extended, but maybe even developed into export cuts, because this was the problem. All these countries, OPEC, non-OPEC, OPEC plus Russia and a few others, had agreed to stop producing as much, but they were sitting on huge reserves which they were quite happily to keep selling. So they need to expand the agreement if we're going to curb the supply to markets to keep prices more buoyant or indeed well off their lows. I mean, looking at the chart, yes, we're at a level that allows us to look at a chart going almost 7 years back, which is quite something given where we were. We may be headed towards a significant resistance level there around $70 a barrel, but it's interesting that it's the first time in a while that we've been able to look as far as the magic $100 mark, from which we fell so sharply in middle of 2014.
Yeah, incredible move down. Now, look at drill down to two of the major players, no pun intended. With regards to, we'll start off with Royal Dutch Shell. Now, certainly a lift in crude is going to help their profit margins. I mean, that's a fact.
Absolutely.
And we can see, obviously, tracking the move upwards in Brent over the recent months. But from a technical point of view of Royal Dutch Shell on its own, what are we looking at here?
Well, first of all, we've been in a strong end of summer momentum, very much echoing the oil price, and that was further extended recently by a strong set of third quarter results, which backed up the process that the continued restructuring and the evolving to a new era of lower oil prices likely for longer was delivering, and the profits were better than expected. The dividend is still strong, and the shares broke up through to fresh 2017 highs, and we're really very near matching the record highs of March 2014 at £26 per share, which is only 3% from where we stand now. If we think back to that Brent chart, a sharp move up to $70 a barrel would quite easily take this, I think, to 26.
Fantastic. So, I mean, it's almost leveraged against the Brent.
To some extent, yes. And to back that up, if we look at the RSI at the bottom of the chart, that's just flirting in and out of an overbought range, but it could quite easily stay there for a good while longer. So, to some extent, the trend is your friend. Yes, it is technically overbought, but a stock can stay overbought for an extremely long length of time. So we'd be looking for that pattern to at least complete at £25.50, but still keeping a very close eye on the oil price itself for potential for it to move back to 26 and match those highs.
Fantastic. And a similar story with BP, and I think they basically said, look, we can make money down at $40 a barrel,
indeed.
And that was their target, and probably similar to Shell. So anything above that is it's Christmas has come early. However, I think investors want to see or will want to see bigger dividends from these companies at some point.
Yes, don't forget BP is still on the mend from what was that 2010 50% drop, and we're playing there with six-year highs, which is something to be said for BP. That's a good showing. Again, continued restructuring, selling off assets, paying off all those heavy legal costs, as well as, like Shell, adjusting to this new era of lower oil prices. But the trend still there is positive. It's also been in a bullish flag pattern, which we can't quite see there because we're looking at a monthly chart. It's a long time since we've been looking at monthly charts for the likes of BP. But if we do get a breakout to, say, £5.50, you'd be considering that since beginning of 2016 there, that it's been a consolidation phase through most of 2017, which could release the shares for a further rise. It's still a solid dividend yield. I think investors would like to see more, but there's a balance to be played between starting to throw money around to pay loyal investors versus what is still an evolving situation both in the oil market and there still are small legal headwinds that they're settling up. But for the moment, the trend there is positive for both BP and Shell. I think they help each other. We had both reacted positively to, I can't remember which results came first, BP or Shell, but they both did well after that. And again, when it was backed up by the second of the pair, then both shares did well again, seeing it as a sector trend, which is a welcome one to see finally.
And just finally, Aramco, Saudi Arabia Aramco, if they do release this to the market,
yes.
I mean, you wonder if the Saudis are controlling their own book at the moment, because certainly that helps their valuation as and when that comes to market. If, and the question is if, we do see a float or a partial float and a listing in the UK, it will go straight into the FTSE, no doubt there. How do you think fund managers will look at that? Because obviously they're waiting on oils will shift. Would it be a case of maybe trimming back some of their portfolios in Shell and BP? Well,
I mean, as it is, BP and Shell make, I believe, it's 13 to 14% of the FTSE, which is a huge amount. And that's before you integrate the oil majors into the commodity sector as a whole, which would take it, well beyond 25%. So it would totally shake up the weightings that the fund managers would have to provide the exposure necessary to beat the benchmark or indeed follow whatever they're tracking. Interesting, we had Donald Trump saying we'd really love to have this IPO in New York, which is of interest. We still don't know where it's going to be. We had the issue about did the FCA meet Aramco to discuss the listing requirements and what rules could be bent, shall we say? So I mean, it's totally up in the air for the moment. They might well be quite happy to hold off, waiting to see whether the oil price does punch up. For example, Brent up through 70. If that opens the door to moving back towards the 100 mark, although it would give them a huge listing, they're still sitting on huge. But do they necessarily need to? Don't forget, the listing was almost on the premise that we were stuck with a low oil price, and this was a way of releasing funds to make up for the fact that they had less revenues in for a very oil hungry and a very helpful society for its citizens, based on earning loads of money from oil. With that having changed over the last 18 months to 2 years, they're reacting to that, but now do they necessarily need to? If oil is going to maintain this uptrend, they're sitting, as you said, BP and Shell, I think they're talking about break-even prices, the mid to high 40s, well above those now. It's a nice bit of breathing room. Do the Saudis actually need to do this now?
Fantastic. It's a very key point. Very interesting. Mike, thank you very much for joining us today.
Thank you.